This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.
Welcome everyone to the latest episode of Tax Records, the podcast produced by the Hall & Wilcox tax team. My name is Todd Bromwich and I'm a senior associate, and I'm joined by my colleague and partner, Frank Knobris.
Thank you, Todd. It's a pleasure to be with you.
The topic for today is all about the Australian Taxation Office's Top 500 and Next 5,000 targeted compliance programs. And we'll share some of our observations from recent experience assisting taxpayers with such reviews. We've had a number of these reviews lately, so we thought it was an opportune time to speak to you about it. Frank, we spoke about the ATO's Top 500 and Next 5,000 programs back in season 1 of Tax Records. Could you briefly recap the programs and what taxpayers fit within these bands?
Sure, Todd, and you're absolutely right. We did talk about these two compliance programs in season 1, and I believe in our very first recording. So nice to revisit this issue again. So as you've already mentioned, the Top 500 and Next 5,000 are two targeted ATO compliance programs. A top 500 taxpayer, there are a number of definitions of what a top 500 taxpayer is, but it is a taxpayer or a taxpayer group that has either over $350 million of turnover, and that's irrespective of what its assets are, or conversely, over $500 million of assets, irrespective of what its turnover is, or a middle ground sort of position where the taxpayer has over $100 million of turnover and over $250 million in assets. The Next 5,000 taxpayer definition is a little simpler. A Next 5,000 taxpayer is defined generally as a taxpayer or taxpayer group that has controls wealth of more than $50 million. And if that's the definition that applies, my sort of reaction to that is, well, I'm surprised there's only maybe 5,000 taxpayers who fit into that category, that there might be many, many more. And of course, Todd, as we spoke in the first series and in the first podcast, the program really rests on and revolves around this concept of justified trust. So that reflects the fact that this is a proactive approach to these taxpayers by the Commissioner. It's a review of not only their compliance, but also their governance processes and procedures and governance attitude towards tax. And the sort of carrot for taxpayers for being active and willing participants in this scheme is that if they do achieve a level of justified trust, then they can expect a lesser degree of ATO scrutiny in the future.
Well, back in November 2021, the ATO published a findings report. Could you give us just a bit of an overview of that and what that report identified as some of the key findings?
Sure, Todd, and you're right. The ATO took a pause and reported on the outcomes of its Next 5,000 and Top 500 programs back in November 2021. A pretty comprehensive report from the ATO, and I think they should be applauded for their transparency in releasing those findings. But a couple of the key points, if I can summarise them, were the ATO had at that time conducted and seen through to their conclusion a number of these programs for a number of taxpayers. They found that there was a sense of tax risk governance and that there were processes, but these processes were not necessarily documented in a sort of guiding document in many cases, if not most. The ATO found that those taxpayers who tended to get through these programs and not have any compliance issues or ongoing compliance risks tended to be those groups that documented their tax review processes comprehensively, and also that taxpayer groups who had close relationships with their external advisors, both on the accounting and tax law side or legal side, tended to make, as you would expect, significantly less mistakes and errors than those taxpayers who did not. And if you'll just indulge me for a second, Todd, because as you know, I do like stats and data, but the report also produced some pretty interesting, what I thought, I thought it was interesting, sort of demographic analysis, almost profiling what the typical next 5,000 group sort of looks like. And based on the ATO's data and its analysis, the typical next 5,000 group is a group comprising, on average, 16 different entities, comprising 7 companies and 4 trusts. Typical group would have a group head aged 65 years or older. It would have 39 employees. It would have total income in the order of 9.4 million. It would have total wealth in the order of 80.3 million. And it would have income tax in the order of 700,000. So if you have a client who fits that sort of demographic profile, then congratulations, you are a typical next 5,000 group.
Thanks, Frank. And you're not wrong, you do love a few stats, and it'll be interesting to see when they release these finding reports year on year or in whatever period they choose, to see how that demographic changes over time.
You can almost call me the Bruce McAvaney of tax when it comes to my love of statistics and data. Yes, but carry on.
Golden tonsils. No doubt the ATO, though, has seen some recurring issues arising. You've got a fair sample size of, top 500, next 5,000. Do you have any sense of what those recurring issues are?
Sure. No, and this is another element of the report that was quite useful, and that was in identifying some of the areas of tax where the ATO found recurring issues. And I think when I start reeling this off, it won't really come as a surprise to anybody that these were the areas where there were problems. But of course, Division 7A in a privately owned family group has to be very carefully managed, because there's a lot of risk and there's a lot of complexity, and very often there are mistakes. Tax losses, and especially the classification of capital losses as revenue losses, and a related question to that, the characterization of a gain or of an amount as being on either revenue or capital account. And you and I both know and have done a lot of work trying to manage and advise on these issues, especially in the property area, where this can be, the revenue capital distinction can be controversial a lot of the time. Some of the other issues, again, none of which comes as a surprise, was poorly or inadequately documented intergroup or interfamily transactions. And we know that this is a typical feature of privately owned groups. Your typical privately owned group, even if it's a very big one, won't necessarily be applying the documentation and governance standards that you might see in a BHP or any other publicly listed company. Things can happen a little bit more informally, and it's very often the case that lack of formality in documentation has caused taxpayers to come unstuck. And of course, probably the issue that I've been banging on about for years and years ad nauseum, and that is the issue of poorly documented or invalid or erroneous trust resolutions.
Thanks, Frank. Well, now we might get into some of the nitty-gritty. If I'm a taxpayer, how do I know when a top 500 or next 5,000 review has commenced? How do I know I'm the subject of one of these reviews? And do we have a sense of what the initial correspondence is like? Is it standardised? Is it tailored? What does it look like?
Sure. So, Todd, I mean, I've sort of come to facetiously refer to these letters as your, welcome to the club letter. And I've said to a few clients, maybe they should take it as a compliment that they've been picked as a top.
We've made it. We've made it to the top.
You've made it. You've made it big if you've received one of these letters, which I call the welcome to the club letter. And it tends to be, at least from what we've seen, and I think our experience would be a reflection of the processes it would apply more generally. But the initial letter tends to be, it is specific in the sense that it identifies the taxpayer and identifies the group and often identifies the relevant entities in the group. But it is general in the sense that it doesn't get into the specifics of particular compliance points that the ATO wants to examine in more depth. So you receive a letter, welcoming you to the program, so to speak. The letter tends to outline what the program will entail and how the process will go, and provide you with a rather charming little diagrammatical representation of the process, outlining the various steps that the client should expect to unfold throughout the review process. And that is your sort of first bit of communication with the ATO. Generally, what happens after that is that the process starts to become a little bit more detailed, and the ATO starts to put a little bit more meat on the bones and ask you more detailed questions. And typically what you would receive after that initial welcome to the club letter is a request, firstly, for more information and what I might describe as source documents. So often constitutions or trust deeds, etc. Financial statements and other related documents concerning not only the relevant taxpayer identified in the initial correspondence, but also other entities that taxpayer controls or has an association with.
Okay, so if I'm a taxpayer and I get one of these letters, what should I do as a first step? Should I make a panicked call to one Frankenopoulos?
Well, one can rarely go wrong by making a panicked call to Frankenopoulos. But no, I think what clients, taxpayers should be doing as a first step is most certainly, if this correspondence hasn't been received by their tax agent or external accountant to begin with, and usually it is, but they should certainly bring their external accountant or advisor into the tent, and they should acknowledge the ATO's correspondence. And usually in this correspondence, the ATO will identify the sort of case officer who will be managing the particular audit. So, it may be Mr. or Mrs. Smith at ato.gov.au. I always think it's a good idea for a taxpayer to acknowledge this correspondence and start at least an initial introduction to the ATO compliance officer. And then I think what would happen then is that the relevant information that will be requested should be compiled, and you should really, I think, what I encourage taxpayers to do is to do their own review in-house, and if the taxpayers able to, assisted by an independent and objective outsider or advisor, like a law firm like us, or like one of our other professional colleagues, to sort of really do a review along the lines of what the ATO would be reviewing itself. So, have a look at the source material, do a bit of a sort of DD checklist on some key compliance risks. That's where the information the ATO has put out following its findings on the report can be useful. Think about where the exposures might arise, think about what some of the hotspots might be, and really get yourself prepared. Do the review that the ATO will be doing in-house before you unleash all of that information on the ATO.
Okay, so if there's an issue identified in the course of one of these reviews where, maybe there's been some non-compliance, or where we think we have complied, but the ATO might disagree with the position we've taken, what is a taxpayer's options from that point?
Sure. Well, there's always the option, Todd, and this is certainly what we recommend, where a specific issue has been identified, and if it's not clear there is a high risk of non-compliance, we always recommend that taxpayers and their advisors in that situation, firstly confront the issue, assess the issue, get a second view about the issue, and if there is clear non-compliance, then the best thing for a taxpayer to do in that case would be to address that non-compliance by way of a voluntary disclosure to the Commissioner, which will or should have the effect of providing some relief from penalties. And when you are at this early stage of a review, then the opportunity to make a voluntary disclosure will most of the time exist. If there are issues where there may be a risk, or the risk is appreciable, but there's no clear answer. I mean, an example of that would be if there's an issue about treatment on capital account where it may have been revenue account, or arguably may have been revenue account, or the opposite. And if it hasn't already been done in the front end, which in a perfect world is what you would want clients to do, then I would certainly recommend that clients look to sort of shore up or firm up some of those potentially high risk and material tax issues with more advice or with a reasonably arguable position paper. Doing that gives some support to the position that's taken, or at least lets the taxpayer assess whether or not they should be making a voluntary disclosure.
So Frank, usually in the course of these reviews, our clients will be asked to provide documents to the ATO either informally, or they may receive a formal notice to produce documents. What should taxpayers be aware of when they're furnishing documents to the ATO?
Sure, and that's right, Todd. So as we've already said, you can expect to be required or requested to provide documents at a couple of different stages. In the very early stage, you might be asked to provide base and source documents like constitutions, trust deeds, financial statements, etc. Then once the ATO has progressed to a more detailed review of that source material and base documents, you might be asked to provide more documents responding to more specific queries. And that may happen at a couple of steps along the review. So, when furnishing documents to the ATO, but of course, it's important to be open and transparent and to share documents that the ATO is requesting. But we always urge taxpayers and their advisor or their accounting advisors to be very careful and very discerning in the material that is provided, especially if it is documentation that might comprise advice that might be either legally privileged or privileged, having a quasi-privilege under the accountant's concession. It's quite important, going through this process, not necessarily that you will or can assert privilege over certain documents, etc., at this early stage, but you certainly don't want a taxpayer or their accountant inadvertently waiving the privilege that would belong to the taxpayer as the client, in circumstances where that might not be in the taxpayer's long-term interests. So, of course, the key message there, and the bottom line point in that discussion is, don't sort of just hand over documents indiscriminately. Make sure that there's good control and good awareness, and also some oversight of what is being provided to the ATO, in response to its requests, and what the implications for a taxpayer might be.
Yeah, legal professional privilege is one of those things that I suppose we could probably talk to for quite some time. So I probably won't press you on that anymore, and maybe save that one for the next season of Tax Records. What about interviews? Because we've been to some interviews with our clients with the ATO from time to time. Is it necessary for a taxpayer to attend an interview? And if they do decide to attend, how should they go about it?
Yeah, well, so interviews with the ATO, are never going to be a comfortable experience for taxpayers or their advisors. It can often be. a pretty intimidating experience for a taxpayer to confront, even where it might be completely innocuous, and even where there is no element of any sort of non-compliance, etc. I mean, it just can be one of those unnerving things to have to be in an interview with the ATO. I mean, we have had some taxpayers, and when I use that term here, I mean the actual taxpayer client, not the accountant and so on. But we have had a number of taxpayers who have, quite willingly, wouldn't say enthusiastically, but certainly embraced the opportunity to be in front of the ATO and the ATO people, and to show that they're nothing to be worried about, nothing to hide. They're there to be cooperative and transparent, and where the person is temperamentally suited to such an environment, that can be a good experience. It can be very productive. I've had a couple of taxpayers who have just been the exact opposite. Have not wanted to attend the ATO meeting, and despite a clear explanation of everything that might mean, have decided to not attend, and have instead instructed their accountant or either us to attend the meeting on their behalf. Again, no adverse inference should be drawn from a taxpayer's unwillingness to attend the issue, but that's not to say that it actually may not cause some adverse inference to be drawn from their non-attendance. But at a more practical level, I think the interview can be a pretty, is an important element and part of this process. A lot does I think a lot does turn on what comes out through the interview. I think it should be managed with some care, and it should be managed carefully. And my practical experience has been that typically the ATO will provide an agenda. I do sort of urge taxpayers and accountants to request from the ATO more detail in that agenda, not necessarily so that every question is on notice, but so that there is a clear indication of what information or topics will be addressed at the meeting. If there are any documents that the interviewee will be taken to, that those documents are identified. There is, it's not like a cross-examination. It is something that that can be prepared for, and where a taxpayer should and can be able to go in with their eyes open and fully armed with a good sense of what's going to be, what questions are going to be put to them.
So what about the back end of these reviews? And say the ATO concludes their review of a taxpayer, they may not find any explicit non-compliance. They may have just made maybe some comments on their governance processes and some recommendations. I mean, should that be taken as a clean bill of health? Can our clients rely on that to essentially say, well, there's no skeletons in the closet for those past years?
Sure. And Todd, we have had, a couple of matters now where we've seen these reviews go sort of end to end, right from the start to right to the very end. And, we have had some clients who have come through with no findings of any non-compliance or no findings of any material risks. Sure, there were questions along the way that had to be addressed and reconciled. But the ATO did conclude the review with no adverse finding, if I can put it that way. And your question was, well, can you then take that as a clean bill of health? Of course, the ATO is never going to be absolute with anything that it says or anything that it puts to a taxpayer, from the perspective of saying, well, you're all good. We sort of sign off that everything is fine for prior years. The ATO always, and I think quite properly, reserves the right to examine further issues, or if more information comes to light, if more documentation comes to light, or if the taxpayer has not been open and transparent with the ATO in any way. And that's why I think it's important throughout the process, and especially at the commencement, to encourage clients and taxpayers to be as transparent as they possibly can. So, I mean, it's very helpful, and I think it should give a client some confidence that their tax compliance is sound, and that they are a taxpayer who would fit within the justified trust category if they did come through a review like this, and it was finalised with no adverse findings, or if there were adverse findings, if they were fixed along the way, and there was evidence that there was sort of system change or process change to embed these new processes that would prevent these issues from recurring. But of course, it's never absolute.
During these reviews, the taxpayers are often, quizzed about their tax governance processes. And also at the end of the review, one of the outcomes that we see might be a recommendation to prepare a more formal tax governance policy to apply for the group. In your experience, what does this look like, and what do we do here?
Sure. So you're exactly right. I mean, that this whole program, the anchor of it is the ATO's desire to encourage and engender better tax risk governance practices in the high wealth segment of the Australian taxpaying community. That is stressed at the very start of the program. It's stressed in the program's parameters, and there will, in every review, at least every review we've had, when a taxpayer is asked to outline, what their tax risk framework and process is. Now, the question or the response that we get, every single time we ask a taxpayer, to what we're going to say in response to the question about their tax risk governance process. I mean, every taxpayer says, that's why I've got an accountant, and every accountant says, well, that's why they've got me, and I'm there to manage risks. I'm there to identify risks and help the client to mitigate them. And that's why Hall and Wilcox and our like exist, so that where there are material tax issues, they can seek further advice or a ruling or a reasonably arguable position from us. And I think the ATO, as the ATO's own data shows, most private businesses would not document this in the way that you might see in a more complex, sophisticated organisation with external shareholders, like a listed company, for example. So I've never seen somebody have, maybe there are, but I've never seen somebody have a formal documented tax risk governance policy sitting on the shelf ready to give to the tax office. It is important, however, when you do get to the back end of a review, and when a review is concluded, it's not a kind of, it's not mandatory, but there is, I think, a pretty strong urging by the tax office that private groups who have been through this review try and document their tax risk governance processes more formally. And, in our practice, we've, as I said, not only have we gone through the whole gamut of the review process, but we've also got to that end bit where we've had to help clients to sort of formalise and document their tax risk governance policy. And I won't say that there's one document that's going to solve the issue for everybody, or there's not going to be one document or one precedent that's going to be right for everyone. And I don't think either that it has to be a sort of over-engineered, overly complex, very sort of, extensive sort of document. I mean, I think what the ATO, I mean, my feeling, this is my personal opinion, what the ATO wants to see people doing is, having a clear sense of, a few important things. The first important thing is, who has the responsibility for managing tax issues and tax risk. And I don't think that's only the external accountant. I think there is an expectation that the principals of a complex and high wealth group will have a mind that is focused on tax and tax risk. I think the second important thing, which relates to the first point, hopefully doesn't undercut it, is that high complexity, high wealth groups should have strong, trusted relationships with their external advisors who provide support and specialist support when it comes to these tax issues. The identification and detection process has to start, within the group and start with its immediate accounting advisors. But then when that has been identified, there needs to be a team or a support network of people who can help guide clients through these risks. I think the third important element is that there needs to be a sense of, key tax hotspots. What are the transactions that we do? What are the issues that we do that, might be controversial or might be a bit of a tax hotspot? What is something where we could be the subject of some ATO scrutiny? There might be a transaction, there might be a history of intergroup loans, it might be a history of intergroup connections, it might be having really old trust deeds in the group that no one's really read for a while, and where there might be mistakes. Identify those hotspots and have a sense of materiality around the transactions that you're doing. And finally, I think sort of write that down and use it in a way that might be, it's going to have some practical benefit, right? I mean, it should be, like I say, I think it's something that you prepare to tick a box on a tax office letter to say you should have one of these things, and then you stick it on the shelf and forget about it. This is really going to be useful if it's used as a practical document. And I think what I would envisage and the way that we've tried to prepare them is that it is something that people can actually pick up and use and go through as part of their, quarterly financial reviews, as part of their tax preparation meetings with their accountants, as part of their year-end consultations with their accountants and advisors, and so on and so forth. I mean, if this whole thing becomes just another kind of tax document that you create to tick a box and nobody ever picks up again, then I don't know that this has really achieved much.
Thanks, Frank. Some good practical advice to cap off our discussion of the ATO's top 500 and next 5,000 targeted compliance programs. And thanks to our listeners for tuning into the latest episode of our Tax Records podcast series. We trust that you found the information useful, and please reach out to our team if you have any questions. You can find Frank and my details on our website, wallandwilcox.com.au, or you can connect with us on LinkedIn. If you enjoyed today's episode, please rate, review, and follow our podcast wherever you listen to podcasts. You can subscribe on our website to be notified of new episodes.